Okay, I think Dieter, we're good to go. If that's okay with you.
Yes, please do.
All right, so hello everyone, and a very warm welcome to today's public background session on the draft IAS issues paper on the structural shifts in the life insurance sector. So my name is Nicola. I am with the IAIS Secretariat, and today we are joined by Dieter Hendricks, who is the chair of our IAS Macroprudential Committee, Monica Ruggiero, chair of our IAS Macroprudential Supervision Working Group, and Videshri Ral, who is my colleague here at the IAS Secretariat. So if you go to the next slide, you will see that the objective of today's session is to provide you with some background as to this issues paper, then briefly cover what is the issues paper outline, providing a summary also of the content in the main sections of the document, then walk you through the consultation process, so how to submit your feedback to this document and by when. And then at the end of the session, we will also open up for questions to see if you would have any questions already at this stage, for instance, on how the consultation process works. Also, please note that this session will be recorded. And we will publish this also on our IAIS website. So with that, let me pass the floor to Dieter Hendricks, the chair of the IAS Macroprudential Committee. Over to you, Dieter.
Thank you, Nicola, and also welcome to everyone from my side. What I'll try to do to kick off this session today is to give you a little bit of background as to where is this issues paper coming from, what is the nature of an issues paper, and where do we seek in particular feedback from you before I pass the floor to Monica, who will go into a little bit more detail in terms of the content of the issues paper. As background, I can flag to everyone that one of the core objectives of the IAS as a supervisory community is to monitor and respond to the key risks and trends in the insurance sector. This was the case already since the adoption of the holistic framework end of 2019. And what we flagged here is that when we look forward to our strategic plan for the upcoming period 2025-2029, this core objective remains one of the key objectives for IAS to achieve. The tool that we use to monitor these key risks and trends is what we call our global monitoring exercise. And since 2020, this global monitoring exercise has been used as a tool to monitor the trends, to include these key risks and trends into the collective discussion and to report the outcome of whatever we analyze in scope of this key risk and trends discussion to the public and to the FSB. Now, one of the key risk and trends that we've spotted since some time now is the structural shifts in the life insurance sector. Usually we split these structural shifts into two underlying trends. The first one being the increased allocations into investments or alternative assets, such as private credit, private equity, and securitizations. And secondly, the second trend that we have observed is the increased use of cross-border asset-intensive reinsurance. Sometimes these two shifts or trends are interlinked. We have therefore always captured them under this one theme, under this structural shifts theme, so as to make sure that we wouldn't miss any interconnections between these two trends, which are currently ongoing. We have been reporting on the outcome of the analysis that we have been performing in these structural shifts ever since 2021 through our Global Insurance Market Report, or GMAR, and we have also been reporting to the FSB. Maybe we can go to the next slide. Yes. So where are we now in this process? We are now in the process of consulting an issues paper, and this issues paper tries to provide an in-depth assessment of the key supervisory issues and practices in response to these structural shifts. One of the ultimate goals also of the issue paper is to inform on whether or not there is a need to enhance certain IAS supervisory and supporting material. First of all, to aid supervisors, but secondly, also to make sure we have a globally coordinated supervisory response to these trends. So we can maybe immediately move to the next slide. Just an important distinction that I want to make, an issues paper is not directly an insurance core principle or an ICP. So the insurance core principle or ICP is our globally accepted framework for insurance supervision. So these principles seek to encourage the maintenance of high supervisory standards for coordination, to have a common understanding of what are the key supervisory principles in terms of supervision amongst all the member jurisdictions of IAS. Now, an issues paper is something which we develop to explore emerging or complex topics that are relevant from the perspective of the insurance sector. The idea is to foster discussion, deepen our understanding of the issue that we want to explore, and recognize who is affected by some of these challenges. This may be insurers themselves, this may be supervisors, this may be policyholders, or in this case of this issue paper, I would say a combination of all three of them. I want to stress that the issue paper on its own is not intending to set supervisory expectations or regulatory requirements. However, it can serve as a foundation, and we'll come back to that later, for further exploration or development of guidance for supervisors. We can also seek to change certain ICPs or standards or introduce best practices. So the issues paper is really a first potential step into exploring further enhancements to supervisory material. Maybe we can go to the next, and the next one. So today, what we want to do is to introduce to you your opportunity for feedback on the issues paper, such as it's been drafted and published right now. We'll go through the different chapters of this issue paper. So we'll have a chapter dedicated to the increased allocation to alternative assets in life insurance portfolios across the globe. That was our first trend. The second trend we'll explore under a third chapter, the rising adoption of asset-intensive reinsurance. We've included a chapter where we try to derive any potential macroprudential and financial stability considerations that come along with these two trends. And last but not least, and that links to what I've been saying on the last few slides, there is a fifth chapter on the potential review and enhancement of IAS supervisory material. We have the document, the issue paper on its own, and we also have a separate document where we try to structure how we would like to gather the feedback from you as stakeholders on this document. And I'll now pass the floor to Monica, who will go a little bit more into detail in terms of the content of the issues paper. So please, Monica.
Thank you very much, Leader. Good morning, good afternoon, good evening to everyone. Thank you for letting me the opportunity to introduce the content of the issue paper. So echoing what Leader has already said, it's important the structural shift has been highlighted and closely monitored by IAS within the life insurance sector, and the subject has been further explored, and the findings of the latest analysis are included in this issue paper, where the primary objective is to provide a comprehensive analysis of this structural shift, exploring in deep this emerging trend, providing a framework for understanding macroprudential and financial stability implication, and identify, as Dieter said, the potential area for enhancement in the IAS supervisory material. It is important also to premise that while some trends, such as the increased allocation to alternative assets, may also be relevant to other type of insurance business, this paper focuses solely on the life insurance sector. So this is particularly important for the review of the supervisory material that need to take into account the emerging risk. So as Dieter explained before, the paper has 5 case sections, and each area of the issue paper have specific focus. We can start from the alternative asset perspective. That is the first section of the issue paper that focus in particular. So we can move to the slide exactly. And the main focus is obtain a better understanding of current trends in alternative asset and drives behind this and the drivers behind this trend. Moreover, it's important to establish a clear definition of alternative asset using principle and criteria to classify this investment, and evaluate also issues such as hidden leverage, liquidity risk, and credit rating, as well as regulatory capital related issues associated with alternative asset. Referring to the better understanding, global increasing of alternative asset, in particular supply of private credit, private equity, real estate infrastructure, and hedge fund has been consistently increasing. And this growth was driven by several factors, such as increasing demand by investors seeking diversification and higher return, the growing number of alternative investment managers as well, is important to take it into account, and hence expansion of investment opportunity. But it's important also to consider the impact of the technological advancement and ultimately the regulatory change. The classification
yes? Sorry to interrupt, but I see in the chat that apparently some people are not able to see the slides. So I was wondering whether this is a broader issue or whether it's just a few
if you go back to the previous slide, please. Okay, perfect. Okay, it's fine. So the classification, I just want to say that
it's just to confirm that there are people who can see the slides. So if you cannot see the slides, it's probably an issue on your side. Sorry for that.
Okay.
Monica, go ahead.
Okay, thank you. So go back to the previous slide. So now maybe I hope that the slide is clear. Okay, so coming back to the classification, so the global increasing the classification of regulatory treatment of alternative asset varies widely across jurisdiction and reflecting distinct capital market characteristic and stage of development as well as regulatory framework. One of the primary challenge in regulatory and monitoring alternative asset is the absence of a universal accepted definition. And the need for a clear definition is driven by the fact that the lack of broadly accepted alternative asset definition make quantifying the trend difficult. And this absence of comprehensive and standardized data further complicates effort to accurately measure and analyze the global growth of alternative assets and their impact of life insurance. For this reason, the issue paper need to consider carefully to put forward a high-level and principle-based definition of alternative asset, and this approach helps to build a common understanding among supervisors and to facilitate cooperation across jurisdiction, and allowing for this for the diverse characteristic of alternative asset. In fact, the definition states that alternative assets are assets which display a high degree of either valuation uncertainty, liquidity, or complexity, or a combination of these criteria. And when applying this definition, it is crucial to consider specific asset characteristics that may be identified and addressed in local regulatory framework. And additionally, the exercise of a local trade market, the existence of a local trade market or level of liquidity, including secondary market, that is an important aspect to take into account, remain an important aspect. The evaluation need to be based on the 3 key principles that we mentioned, as we can see also in the chart. And so valuation, uncertainty, liquidity, and complexity, and each containing multiple dimensions that require detailed consideration, of course. And a principle-based approach is crucial to enable the necessary flexibility in supervision. The monitoring of global trend within the alternative asset could benefit from an harmonizing description in order to be able to extract the relevant data from supervisory reporting. And this is important because such reporting is also essential to assess global concentration and global financial stability implication. We can move to the next slide. And to have a general overview of the driver, it is important to understand the possible benefit linked to the alternative asset. Some of these I have already exposed in the first slide. So enhanced portfolio diversification, higher potential return, alignment with long-term liability. And it's important also to consider inflection age and funding a real economy, taking into account in particular specific assets such as private equity, private debt, infrastructure. In order to have a complete overview, on the other hand, it is important to understand the risk and concern linked to the alternative asset that need to be considered with attention. Case supervisory concern with alternative assets stem from the 3 risk-based principles outlined before, included in the definition, so valuation uncertainty, liquidity, and complexity. And moreover, we also touch several other points that are important, such as hidden leverage, links to the private equity firm and possible conflict of interest, the reliability of credit rating as well, and regulatory capital related issue and information gap. The issue paper also touched the point regarding the possible supervisory response or the first experience and the response from the supervisor that regarding this increasing risk, try to enhance the risk management framework, improve monitoring and reporting, regular capital adequacy review, or also improve the stress testing and analysis scenario if needed. Try to work on the conflict of interest policy, and in order, one of the important measures is increased international cooperation. So it's important for a complete overview. The issue paper give a first draft of the main supervisory, also from the main supervisory response, take from alternative asset also an analysis of the macroeconomic consideration as well. We can move to the next slide. Thank you. And the next, the third aspect, the third core aspect of the issue paper deal with the asset-intensive reinsurance. And this is in fact the second structural shift in IAS, and the issue paper represent the increased use, as leader said, of asset-intensive reinsurance arrangement. These arrangements have grown rapidly over the last decade, with a notable rise in cross-border asset-intensive reinsurance. And as demand of asset-intensive products continue to grow, so does the reinsurance of this product across different jurisdictions. As I mentioned before, the IAS and this issue paper identify a structural shift in insurance allocation to alternative assets that can be more pronounced in insurance with asset-intensive products such as annuity, universal life, pension risk transfers, and long-term care products, where investment risk is a significant risk being underwritten by the insurance. This section is dedicated focus to gaining a better understanding of asset-intensive reinsurance, try to understand how jurisdictional difference in reserving, capital requirement, and investment flexibility are driving the rise of the asset-intensive reinsurance activity, and try also to summarize the supervisory risk assessment and the corresponding supervisory response to this risk. Regarding the understanding of asset-intensive reinsurance, the paper clarified that is a reinsurance risk transfers arrangement between 2 entities, and it's characterized by a transfer of significant investment risk associated with some insurance liability. It's typically associated with insurance product, as I previously explained, that exposed to insurance to relatively more significant investment risk than biometric risk, and are accompanied by large upfront premium payments. The issue paper take evidence of the benefits both from cedent and counterparties in order to understand the reason underlying this growth of asset-intensive reinsurance arrangement. Moreover, any other aspects are examined, such as determination events in terms of solvency, performance, and recognition. Try to pay attention to the investment flexibility, recapture risk, and collateral arrangement that are aspects that are addressed and analyzed in the issue paper. Also in view of the educative purpose of the paper itself. Collateral aspect is a crucial point for the risk connected to the asset-intensive ratio, and it is explained in the issue paper itself. Many are the driver behind the asset-intensive reinsurance are highlighted as flexibility in capital raising and taxation. Even the supervisory recognition is considering in this analysis and is considered some driver for the growth of some specific asset-intensive ratio, and in particular towards specific jurisdiction. Another factor driving ratio to include a facilitating business, environmental, and their global marketplaces. This encompasses the viability of relevant service provider, ease and speed of setup and operation, and establish a process that quickly match new capital and new opportunity. But the main object of the asset-intensive reinsurance sectors is in particular to understand reserve evaluation, so in terms of cash flow assumption, discounting and adjustment and additional liability, capital requirement and investment flexibility in different jurisdictions, and the extent to which differences between them can drive the asset-intensive reinsurance activity. The comparison was made between regulator frameworks for a simple of jurisdiction with significant market for asset-intensive reinsurance product. And an important aspect in the comparison is to consider the interaction of insurance liability and capital, as a different jurisdiction may address a similar risk but in different places. Further key difference related to the jurisdictional approach to investment flexibility, moreover, and some jurisdictions have principle-based frameworks as well, in particular in the investment flexibility, and granting latitude in investment choice subject to guardrail or safeguard. Another may have more prescriptive limits or a combination of principle and prescription. So the qualitative analysis has been supported by the quantitative analysis conducted by the quantitative exercise, and we can move to the next slide. That should be viewed as demonstrating that the difference in jurisdictional approach can lead to material quantitative differences. And it does not compare jurisdictions themselves, as it is based on a sample of one hypothetical transaction that was designed to control for many relevant variables, and based on a simplified specific template cash flow and on a simplified other simple size. The exercise show difference in capital in the total asset requirement, and these were driven by different elements. And we noted in particular the impact of discount rate on total asset requirement for some volunteers that participate to this quantitative exercise. Has observed that it's important to highlight the connection with the higher spread, with the higher discount rate, and with the effect on the liability. As observed, there can be several material drivers that are contributing to the growth of the asset-intensive reinsurance. From the analysis and confirmed through ongoing discussion with some market participant and supervisor that we have during all this period, we take into account all the findings received during this discussion. It appears that one of the drivers of the growth of the use of that asset-intensive reinsurance is the leveraging of jurisdictional difference in reserving approach, capital requirement, or investment flexibility. So it is also clear that there are other important drivers, as mentioned in part mentioned before. not directly related to reserve or capital requirement or investment flexibility, but that contribute to drive cedents' growing appetite for asset-intensive reinsurance. However, it's important to precise also that we always have to keep in mind that every arrangement is different from the other, and this could make the difference. If we can move to the next slide, finally, the asset-intensive reinsurance section provide insight to identify supervisor concern and potential initiative in place to address this concern. The main one was the complexity, so multiple jurisdiction, asset manager, investor, and reinsurance involved in the process and in the transaction. The concentration risk that also could have the implications from a financial stability perspective. So, and conflict of interest, in particular when investment in fund collateral is when there are private equity owner in this investment fund collateral. And also, another important aspect is the recapture risk. But other element of concern, as we consider in the issue paper, such as the knowledge gaps, the information exchange obstacle, the interplay of profitable goals and compliance with accounting standard that are also examined inside the issue paper. It's important also to understand the supervisory response. We had the opportunity to examine also this aspect, and in particular, we noted that for the asset-intensive reinsurance perspective, we noted an enhanced monitoring or enhanced risk management framework, such as a particular good initiative regarding the pre-approval requirement regarding the asset-intensive reinsurance arrangement. Recap to risk planning, life insurance stress test when is needed, and also for this section, it's become crucial the increased international cooperation. So I will give now the floor to Weiderschen Rollplel to the IIS to introduce the important implication concerning the asset-intensive reinsurance and the alternative asset addressed in the issue paper. That is other two important section for addressed by this issue paper. So over to you, Dash. Thank you very much.
Thank you, Monica, and good day to everyone, and thank you for joining today's session. So in the slides to follow, I'll just go through very high level some of the key macroprudential and financial stability implications that we've outlined in the paper. And then I will also take you through the process of providing feedback and the next steps in terms of finalizing the issues paper. So on the slide, the paper indicates that the global insurance sector's exposure to alternative assets and asset-intensive reinsurance remains relatively limited. As Dita mentioned, we've done quite a bit of analysis on this, so you can refer to the GMAS 2021 to 2024. So basically reducing any imminent financial stability risks because of their limited exposure. But in some cases, there are pockets of vulnerabilities and significant regional exposures. So the point we want to make here is that continued growth could amplify these vulnerabilities, and these include forced asset liquidations, lending market disruptions, and financial instability from widespread asset-intensive reinsurance recaptures. We also looked at interconnectedness within broader markets, which could also compound these risks due to high leverage in fund structures that could potentially trigger defaults, losses, and fire sales, which in turn could spill over to insurers and destabilize the financial system in its entirety. So this would depend on the pace of growth and also high exposures. Concentration of asset-intensive reinsurance transactions that's concentrated amongst a few large insurers and jurisdictions could further heighten these systemic risks. So overall, it does become increasingly essential to close some of these information gaps and enhance risk management practices, as well as sharing best practices to mitigate these risks. Because ultimately, we would want to safeguard the insurance sector's stability and its role in the global financial system. We did a review of the IIS supervisory material at this stage as well, and the slide just highlights the importance of ensuring that supervisory material keeps pace with this evolving landscape of the insurance sector. So we know now that increased investment in alternative assets and a rise in asset-intensive reinsurance agreements often involve complex cross-border transactions. So to address these developments, we reviewed our supervisory material to ensure that it remains robust and is effective in managing these emerging risks. This review also leverages insights from earlier IIS work that we've done and valuable feedback from stakeholder discussions, for example, Chief Risk Officer engagements, as well as the global monitoring exercise. So over the past few years, we've done a lot of these engagements. Overall, this assessment found that the IIS insurance core principles do provide broad coverage of the identified risks, but it becomes very important to adopt a holistic approach to address potential overlaps and also strengthen the effectiveness of supervision. So overall, I've given you the conclusion and we've highlighted some potential for enhancements. So the ICPs are listed here in the table: ICP 3, 7, 8, 9, 13, 14, 15, 16, 20, 24, 25. I won't go through all of them, but just to point out that the detail can be found in the issues paper, and any refinements will ensure that we remain proactive and coordinated in addressing these emerging trends and ultimately to strengthen the global supervisory framework. So I'll just move off the technical aspects now, and we can go to the feed to some of the process and the feedback from stakeholders. So when we're dealing with such intricate details and such an important topic, as with others, stakeholder feedback is the heart of such important topics. So your input becomes really crucial to us in helping us shape this final issue paper. We are inviting feedback on this consultation by the 19th of May, after which the consultation will be closed. In total, there are 26 questions. They cover all sections of the issues paper, but important to also point out that all questions are optional. So you might want to focus on the areas that are most relevant to your areas of business. Once we receive the feedback, it will be summarized in a separate document, and this is to ensure transparency as well as inclusivity. So we really do encourage you to share your thoughts, and in certain instances where you can, provide us with explicit comments or possible solutions to areas that you think need further development. That said, even small insights can have quite a meaningful impact on enhancing our work. We've made it easy for you to share your feedback, and we provided a consultation tool that will guide you through the process, so you can use the tool through the link provided to submit your responses. If you prefer, you can choose to keep your comments confidential. Otherwise, they will be published on the IIS website. And of small note, formatting might not always carry over perfectly from other software packages such as Word. So it might be a good idea to double check your input before submitting. You might also save your draft and return to it later, but just to emphasize again that only officially submitted responses via the consultation tool will be considered. If you do have any questions on the process or need assistance, please feel free to reach out to myself, Budeshri Ruplal, at the Secretariat, at the email address that's indicated on the slide. And then finally, just moving on to the last slide of this presentation timeline. So as you are aware, we did launch the issues paper on the 19th of March. Today's background session is part of this process. Deadline for submitting comments is on the 19th of May, and by the fourth quarter of this year, we aim to publish the final paper. So this timeline ensures that we have a structured and transparent process to gather feedback and finalize the issues paper in a timely manner. So thank you very much for your attention. With that, I'll now hand back to Dieter for the facilitation of the Q&A session. Back to you, Dieter.
Thank you, Dash. Thank you, Monica, as well. I hope we've been giving you at least a high-level flavor of what is in the issues paper. Now, the paper, as you may have noticed, is quite extensive, so we would have been unable to cover all the details during this short session. But we're happy to answer any questions you may have at this stage with regard to the consultation procedure. I think Dash has already explained a little bit the steps and how to understand the timing in terms of this consultation, but if you would have other questions, do not hesitate. In the meanwhile, I see there are already a few questions that are transferred through the chat function. I believe that most of these questions can be answered via reference to the paper itself, where I hope we have explained many of these issues. So, for instance, there is a definition of hidden leverage in the paper where we try to flag that hidden leverage in this case for us is those instances that are difficult to identify or to measure, where it's difficult to identify or to measure the leverage from a supervisory perspective. This may be due to the complexity of the investment, or for instance due to the unavailability of data, recognizing of course that this may be a gray zone from time to time, and that will of course also depend on the nature of the investment itself and on the data which is available. For instance, also the question on illiquidity. I think here it's important to notice that indeed illiquidity is one of the three aspects that we want to look at when we talk about alternative assets, and we do take into account, of course, the specific market characteristics. We do recognize that the same asset may be liquid on some markets and not so liquid on others. So all those nuances we of course try to take on board. That's also why you will see in the figure which was illustrated earlier by I think by Monica, that we've tried to give you a view of how supervisors look at these three aspects. And of course, this may also differ from one market to another. The ranking that was provided here is a sort of aggregation of the supervisory view, but to which extent each of the three principles that we look at are being fulfilled by a certain type of asset can, of course, be very market dependent. Also, for asset-intensive reinsurance, we've provided you with a definition. We, of course, aim here to target those reinsurance contracts that, in particular, transfer most materially the investment risk. In some cases, also underwriting risk would be transferred, but the emphasis here is on those reinsurance transactions that mainly shift investment risk to the reinsurer. And often these transactions, and that's also something which you highlight in the paper, are characterized by a large payment of upfront premiums. So again, here I reckon that there may be contracts where there may be a doubt about whether or not it's asset-intensive reinsurance, but that's also something we try to explore a little bit further in the paper. I also see one question in terms of ratings. I think it's important to know that, of course, we value the aspect of a rating, trying to have a summarized view of the credit quality of a certain investment. I think from a supervisory perspective, it's important that whenever there is a large proportion of an investment in a certain asset category, that we remain attentive to the fact that the insurer is well aware, has a good understanding of this investment, and knows how to cope with it in terms of risk management. So ratings are a valuable information input in that respect, but in case of large proportion of investments, there is an expectation that you do your own analysis and just not only rely on this rating. And this is, by the way, also true from us from the supervisory perspective. So that's a quick summary on some of these questions. There's much more detail in the paper itself, so I really would invite you to take a look at it. If you have any questions right now in terms of the consultation process or one or the other aspect that is covered in the paper, do not hesitate to put up your virtual hand. We'll give you a few minutes to see if there are any questions from participants in that respect.
Dieter, we have a few raised hands. I don't know if you can see them as well.
I can see them as well. Let's take them. Let's try to take them in the chronological order. So
We had 3, now we have 1.
We have 1 left. You go ahead.
Much for the presentation, is really helpful. In terms of the next steps, obviously that you'll have the issue consult, you'll have the responses you'll receive. Do you anticipate any face-to-face engagement or further kind of like discussion around this, maybe at the global seminar or a session on this at all in the summer before you issue the final paper in Q4? And the second question I would have is, if in the Q4 final paper you feel that some enhancements to ICP would be of assistance, do you know how you would then approach that, and under what timescale would you think that would happen?
Thanks, you. Good questions. I think in this phase, so we will be gathering your comments. There will, I believe, be opportunity to engage with you throughout the comment period and even after. I don't know. I have to check with the Secretariat if anything formal is planned in this respect. But at least there will be opportunity to engage. I'm sure on your second question. What I can say now is on the timing of potential enhancements to supervisory material, it's a bit early to say that, to be honest. It would really depend on the extent, first of all, on the feedback that we get from you, and then on the extent that there would be a need to enhance certain material, to update ICPs, etc. Of course, if that is the case, then this will also go again through the necessary consultation procedures, as you all know them. So in this respect, of course, we don't want to give you any unexpected surprises. If this would be the case that enhanced material would be confirmed following the publication of the final version of this paper, I think the work will start in 2026. When the work will end, it's difficult to say, but I'm sure we will keep you posted on that. I don't know if the Secretariat, on the first question, is there anything you may be able to add here, Nicola?
Yeah, I think so. We have our global seminar coming up from 8 to 10 of July. And as each year, we'll probably again have a session on our work within the global monitoring exercise, including these structural shifts. So I think at a high level, stakeholder engagement will continue on these topics.
So we'll make sure to provide you with the necessary opportunity in that respect. I see a next hand up. So Hiro, if that's correct. Maybe me, but I don't seem to hear anything.
Do you hear me?
Yes. Yeah, now we can hear you. Please.
Yes. Oh, yeah. Thank you. Thank you, Dieter. This paper is well thought out and find it very intellectually stimulating as someone previously on the regulator side at the Bank of Japan. That's it. The figure on page 12 in today's presentation. Page 12. This figure shows that the level of TAR can vary significantly across jurisdictions. No, page 12.
12, Nicola, yes.
This one, yes. This figure shows that the level of TAR can vary significantly across jurisdictions for the same product. Is the IAIS suggesting that such differences across jurisdictions should ideally be minimized, or is this figure simply intended as an observation without normative implications? It would be helpful to clarify the intended message of this figure. Thank you.
That's a good question. I think our intention is not at this stage to minimize the differences. The differences are what they are. I think indeed, as you've derived also yourself, the intention is here to be illustrative or to give people an idea of what the impact could be. By the way, and I want to stress that, of course, what you see here is an aggregation of different transactions. But this can be very specific to the exact difference can be very specific from one transaction to another, which is also, I think, illustrated with the whiskers of the box plot. So that's also something we want to stress, that this can be very individually specific, linked to the transaction. And that is, I mean, it is an observation that we have. What we also see is that sometimes these differences do play a role as a driver in terms of these transactions, and it's something that, of course, we want the supervisory community to be aware of at this stage. I hope that helps. Maybe next question from David.
So really useful presentation. Thank you. We've talked about obviously how important asset intensive reinsurance is globally. And I think when one of your colleagues was speaking, you talked about how long it took you to, gather your thoughts and get to where you got to. Do you think 60 days is enough by way of time to respond to something that is really this important? It feels a bit light, is my observation.
That's good and interesting observation. We felt that 60 days was sufficient. Now, if you feel that you have very important comments to make and that you're not able to do it within 60 days, I think we can liaise with the Secretariat. The reality is, of course, that we do aim to be finally ready ourselves with the final paper by the end of this year. And that we have to take into account that once the consultation period is over, taking into account summer, there is also we need some time to cope with your comments, which I have no doubts will be extensive and go into detail. So that is at least also something we need to take into account into our overall timeline. What I also want to stress is, of course, that many of the aspects that are flagged here today have already been flagged by IS through GMAR. Of course, here we go much more into detail. I would say do not hesitate to liaise with us, to at least make sure that you make your most important comments with as good as possible within the foreseen deadline. We have a next question from Joe.
Hello. Is it me you're calling on?
Yes, we can hear you now, please.
Okay, yeah, thank you. I had a follow-up question to the one that Hiro-san mentioned on slide 12. So with respect to, I thought this was a very interesting aspect, but when you talk about total assets required, I just had some questions about how you might have come about that, because various regions, jurisdictions have very different reserve, capital, and other requirements. So sometimes with reinsurance, there's also additional collateral pledge that may be in addition to the reserve or capital requirements. So were you able to take all three of those aspects into account? I think that'd be very hard to do that, but if you did, it'd be good to know.
I think we've tried to indeed take the entire picture into account, but let me revert back to either Monica or the Secretary to confirm which aspects exactly have been taken into account. The idea of the total asset, the TAR, was indeed to make sure that we recognize that the difference can be both at the level of the valuation of the liabilities, of the capital requirements, etc., and to get that broad picture by bringing all those elements together. I don't know who can who wants to add something to that from the either the Secretariat or Monica?
If I may, thank you, Dieter. Thank you for the question. This is based of a specific exercise because it was really a simple specified template cash flow of a portfolio, a specific portfolio of US dollar denominated annuities, and volunteers were asked to value the insurance liability based on the local jurisdictional rule and calculate the regulatory capital requirement, including solvency buffer targeted by management. So for this exercise, we compare the total asset requirement. So this is based, as Dieter said before, to a specific exercise in order to get the opportunity to all the volunteers included in this quantitative exercise to have the same basis. But we know that every agreement could be different. So in the reality, the situation could be different. And so the effect could be different as well in terms of the several aspects that each agreement include. And so this is something, so we take into account, we give the basis for this exercise in order to make a possible comparison among the different entities that participate to this exercise. Moreover, we try to understand also from qualitative point of view the reason behind the specific choice, and we gave a representation in this quantitative exercise, and we try to as it exposed before, to give a specific message that there could be differences in liability, capital requirement, and investment flexibility. And so this is, I hope that this could help to answer to your question, Joe.
I have also a next hand up from Mariana.
From the American Council of Life Insurers. And we just kind of wanted to reiterate an earlier request. We have gone through the paper. It's quite substantive. We think it's quite thoughtful. And we really want to be able to provide thoughtful and constructive responses. So we would respectfully request for a 30-day extension. We understand you're on a tight timeline. We're not trying to delay the year-end goal by any means, but we really would like to have the opportunity to have, provide you with the substantive response that we think your paper deserves. So we would appreciate your consideration of that request.
Okay, duly noted. I will maybe I can liaise also with the Secretariat later today to see what flexibility we have. I also see similar questions popping up in the chat. Let's see what we can do. I mean, I'm all very much in favor of getting your feedback in the most comprehensive way, and I would really like to give you the opportunity to give us that feedback. As said, we have our own strict timelines, but let's see what flexibility we may have to accommodate those requests. I'm not sure we will be able to give you 30 days, but we'll take a look at it. And we'll, in any case, if something would change on that in that respect, I think we can announce it via the website of the IIS. So I hope that helps. Not the definite answer yet, but we'll come back to that.
Maybe Dieter, if I can already provide a bit of color. I think this also relates to your previous point in the sense that we have, of course, already been doing a lot of stakeholder engagement on these topics over the past years. Many of the findings relate back also to GMAR reports. And so I think looking at our timeline, we do have very limited flexibility with respect to the deadline. So one approach that could perhaps be is that you try to submit whatever you have by the deadline, and then we continue stakeholder engagement, over the next months, years on these topics. But I think for this public consultation, to manage expectations, we won't be able to push down the deadline much at this stage, given the tight timeline that we have also vis-a-vis, for instance, the Financial Stability Board, etc., that we are liaising with. But as I said, This is one step in the process of the IAS work on this, and work continues. So there will also be further and future opportunities to liaise with the IAS on these topics. But for this consultation, I think 19 May is pretty fixed.
Let's try to approach it in that respect that whatever is possible on your side by the timeline of 19 May, please provide it to us. It will be important for us to get that as much as possible, your feedback by that timeline. As Nicola said, we have also the timeline of our engagement to FSB, on which there is little to no flexibility. And for us, it's key that we provide our IIS view in what is sometimes also a broader debate. The structural shifts in the life insurance sector have also been picked up by other standard setting bodies than IIS, and I think it's key for us as a supervisory community to continue to have a key voice within that debate, and therefore also your feedback on the issue paper to take into account for the next version. We do understand that it's quite an extensive paper. We do also hope that, at least for those of you that have also followed our GMAR publications, that this paper should not contain too much in terms of surprises, and in that sense, let's hope that you can make as much as possible the timeline by the 19th of May. And as Nicola said, of course, the world will not end on the 19th of May, so there will be continued engagement. And I'll link also back to what you said earlier. There will also be further discussions undoubtedly on this topic in general. Do we have any other questions? I see in the chat also a question on the link with the global monitoring exercise data collection, in which indeed we have decreased our questions with regard to asset intensive reinsurance. That's mainly with the aim that the data that we collect in scope of this work now, and also you've seen this on slide 12, the exercise we did is data that is collected via another process also than the general global monitoring data collection. So it doesn't mean it's of less importance, I would say. But we have also noticed that collecting these typical data and questions through the general GME data collections may not have always been the most efficient way, in a sense that data availability was not always easy for everyone, and we also wanted to take into account the data burden that was created by some of these questions. I hope that provides a little bit an answer in that respect. I'm also seeing a question to share the presentation. So the presentation, if I understood, there is a link being shared within the chat, which was shared near the beginning, to the IAS website, where the slides are available. So the slides should be publicly available via the website, so everyone should have access to that. And I see indeed also the question on the interaction with FSB. We know FSB is interested in the topic as well, and I think it's key for us as IIS, and the issues paper serves as a very important tool in that respect to give our insurance supervisory view on the structural shifts, and we've listed that this means trying to understand the benefits, the concerns, the supervisory reactions, and try to see if we need to enhance our supervisory material. I don't know, Nicola, if you want to add something to that, but I think we're following very closely what other standard setting bodies are doing in this respect, and therefore also the timeliness of this issue paper is key to make sure that we have our input ready on time. Any other questions? Not immediately. Okay. So, recognizing that we've tried to summarize an extensive paper on a few slides, undoubtedly, if you pop up questions whilst reading, do not hesitate to contact us. Please use the opportunity to provide your feedback through the template that is provided for that, and we'll come back to you later, undoubtedly, when we move on to the next phase of our work after the consultation period. So, in any case, thank you very much for your interest. It confirms to us as well that this is an important topic for the insurers community, both the insurance sector themselves, but also the supervisors. And we look forward to receiving your feedback on the issues paper very soon then. Thank you very much for joining, and we'll hear or see each other again soon in the context of this paper, undoubtedly. Thank you for joining, and see you next time.